What is our November I-bond rate projection currently? And should you buy I-bonds and TIPS now, in November, or not at all? Hello, members, super savers, and bond course fans. I hope you're healthy and well. So the Fed's preferred inflation gauge, PCE, or Personal Consumption Expenditures Index, showed that inflation has been slowly moving towards their 2% annual target. PCE cooled again in August, coming in at 2.2% year over year, slightly lower than market expectations of about 2.3%. Core PCE, which excludes more volatile food and energy prices, came in at 2.7%, in line with expectations. With that in mind, here are the three topics that we'll be covering in today's update video. 1. What is our November I-bond rate projection? And should you buy I-bonds now, in November, or not at all? And what about TIPS? Treasury inflation protected securities. 2. Where did Treasury yields end this past week? And 3. What's on the upcoming Treasury auction schedule? And where can you find the best opportunities with new issue agencies, corporates, and brokered CDs now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Here it finally comes, and many thanks to all of you who've waited so patiently for this I-bond and TIPS update. So, our November I-bond rate projection. Let's start with the fixed rate first, because from the emails and comments we've seen, the fixed rate seems to be what's most interesting for many of you in our community, and rightly so, I would say. As our Diamond NestEgg regulars have heard me say often, no one really knows how the Treasury sets the I-bond fixed rate. Having said that, and based on our analysis dating back over a decade, we think we may have cracked the secret code, so to speak. It does appear that since 2015, if we take 65% of the average daily real yield on the 5-year TIPS for the 6 months prior to the I-bond rate reset date, this, together with a bit of rounding, gets us almost exactly to the fixed rate that is then announced by the Treasury most of the time. If you're newer to our channel or need a refresher on how we came to this conclusion, check out these two I-bond fixed rate videos from earlier this year that I've linked below in the first pinned comment for you. So let's calculate our projected I-bond fixed rate. Here is the average daily real yield on the 5-year TIPS from May 1st, 2024 until close of market on Friday. Multiply this by 65%, and we get to a projected next I-bond fixed rate of 1.24%, which we then round down to 1.2%. And this 1.2% is the fixed rate that I expect for all I-bonds that will be issued on or after November 1st, 2024. This is a bit lower than the current fixed rate of 1.3%, but this should come as no surprise given that real yields on TIPS have gone down a bit over the past several months already. Now, let's move on to the projected I-bond inflation rate. Here we have the latest CPIU all items number from August 2024. Divide this by the CPIU all items number at the end of March 2024, the starting point, -1, and we get to this percentage change in CPIU over the past 5 months. Multiply this by 2, and we get to a projected annualized I-bond inflation rate of 1.58% at the moment, keeping in mind that we have 1 more month's worth of CPIU left, which will be announced on October 10th, 2024, meaning these numbers here will likely change. And of course, let's not forget about what we at Diamond NestEgg lovingly refer to as the I-bond bump, the inflation adjustment on the fixed rate, which is basically these two numbers multiplied together. As things stand now, when we multiply the projected I-bond fixed rate and the projected annualized I-bond inflation rate together, we get to a projected bump of about 0.02%. So to get to a projected combined I-bond rate for November, let's add together our projected I-bond fixed rate, our projected I-bond inflation rate, and our projected bump. This results in a projected combined I-bond rate for November of 2.80%, which, as you can see, is significantly lower than the current rate of 4.28%. And regardless of what the September CPIU numbers will be when they're announced in a few weeks' time, given the overall downward trend in inflation, I think that it's realistic to say that the combined I-bond rate for November 1st will probably be lower than the current one. What this means is that if you're retired or about to retire and need some inflation protection in your portfolio, or if you're like us, and I-bonds serve a dual purpose in your overall portfolio as an inflation-protected emergency fund as well as inflation-protected retirement savings, it may make sense to purchase your I-bonds at the current still attractive rates before the November I-bond rate reset, given that our analysis to date indicates that the current I-bond fixed rate and the current I-bond inflation rate will likely be higher now than they will be after the November I-bond rate reset. And do keep in mind that this current I-bond fixed rate of 1.3%, this is the highest I-bond fixed rate in more than a decade and a half. Now, there is no rush to buy. Whether you buy your I-bonds now or whether you buy them in the last week of October, you will still get the current published rate for 6 months after your purchase. And as for us, we're probably going to wait until the last week of October to pick up our I-bonds. Also, if you are considering I-bonds, remember that the fixed rate on I-bonds is essentially equivalent to the real yield on TIPS. And at the current time, the current as well as the projected I-bond fixed rates are lower than the real yields on the 5-year, 10-year, and 30-year TIPS, as you can see here, as they mostly are. TIPS, however, are less straightforward than I-bonds, and their complexity can sometimes be a deterrent for investors. As I always say, everyone's financial journey is different, and never buy what you don't understand. So it may be useful to check out this video here first to see whether TIPS or I-bonds may be a better fit for you. Bond beginners, folks, please refer to Module 6 on TIPS in the course and Module 7 on I-bonds if you need a refresher on either. And be sure to ask any questions you may have at our upcoming course and member live Q&As. So, who's buying I-bonds, who's buying TIPS, and who's buying something else altogether? Drop a comment below and let the community know. Right, now that we've covered the inflation-protected bonds that the Treasury offers, let's move on to the non-inflation protected ones to see what happened to Treasury yields this past week. Let's see where we stand at the end of this eventful week in the bond market and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. With the exception of the 1-month T-bill, Treasury yields were down again on the shorter end of the maturity spectrum as the market continued to digest the first Fed rate cut in 4 years. The 2-year was flat, but everything longer than that continued to move slightly up, as U.S. consumer sentiment kept improving in late September, hitting a 5-month high on confidence of a possible soft landing, as we talked about in last week's update video. Now, it may seem a bit paradoxical to see rates go up on the long end at the same time as when the Fed has just brought down its short-term rate for the first time in 4 years. But there is a rational explanation for why the markets are showing this behavior, for why there may be a method to this madness, so to speak. But more about this later on in the video when we discuss our top corporate bond opportunities. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black, and decreases in rates are shown in red. Treasury yields across nearly all maturities are still lower than where they were at the start of the year, with the exception of the 30-year T-bond, which has re-entered positive territory this week and is now again slightly above where we started the year, even if it's currently by only 2 basis points. The 6-month and the 1-year continue to be down the most, though. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. The 52-week T-bill will also be auctioned off. Other than that, there are no other major Treasury note, bond, or TIPS auctions. For those of you interested in agency and corporate bonds for a bit of a higher yield, here's where the highest yielding new issue agency bonds stand at the time of this taping on Fidelity's platform. For corporate bonds, here's where the highest yielding new issues stand at the moment. And yes, there are only 4. Quite a bit disappointing after the long list we had just last week. Perhaps some of the corporate bond issuers did a similar analysis to the one we did in last week's update video. Link below for your convenience. In that video, we explain why long-term rates could go up even if the Fed brings down the rates at the shorter end. So maybe last week's corporate bond issuers were trying to lock in some lower rates, as they also might be expecting longer dated bond yields to move up if the Fed manages a soft landing. So as I just mentioned, our update video from last week explains in more detail how we think about this phenomenon and why it may potentially not be irrational under some circumstances. But back to this week's corporate bond new issue offering. This highest yielding one here from Verizon. The first call date is in 2 years for those of you who may be interested, meaning that in the worst case scenario, assuming a no default situation, an investor would get this 5% plus coupon for at least the next 2 years. And in the best case scenario, the investor would get it for even longer. The offering period does close on Monday though. Here's the QSIP, and yes, it's also available on Schwab and Vanguard as well, as you can see here. I've linked these 2 how to buy corporate bond videos in the first pinned comment below in case anyone needs some guidance on how to do this. If you're interested in brokered CDs, here's where the highest yielding new issues are currently on Fidelity. Remember that regardless of whether we're talking about agency bonds, corporate bonds, or brokered CDs, the higher yielding ones that are a bit further out in terms of maturity are generally callable right now. So be sure to check what the first call date might be on those. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And if you want to really get up to speed on bond investing and building out your bond portfolio before rates could potentially go down further, then check out this video here on our 2024 bond courses. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.